Friday, August 22nd, 2025, Maneco 64, home of alternative economics and contrarian views. Good morning, Clive.
Good morning, Mario. Good morning to all your viewers and listeners.
Thank you.
Thank God it's Friday.
Yeah, I mean, it doesn't make much difference for me anymore, but yeah, Friday is always a nice day. But anyway, Clive, I got a message from a friend of mine. Well, I met him last year at the Precious Metals Conference in Zurich, and we used the term the Gnome of Zurich. I don't know if you know about that. Those were the Zurich
Yeah,
bankers that basically didn't stop trading gold when the London markets were suspended in the late 60s.
yeah. The gnomes of Zurich squirreled away their Swiss gold inside the Swiss mountains where they couldn't be
Yeah.
bombed.
So yeah, he's into technical analysis a lot, and a lot of times he gets things right, sometimes he doesn't. But we all, none of us gets everything right all the time. I think it's more matter of probabilities with markets. But he told me have a look at the S&P chart. There's a huge divergence with the RSI. So I'm going to bring up a chart that I've drawn up with about the of the S&P and what a divergence is. So we've got the top here in the beginning of July, and RSI made a new high as well. So new high in S&P, new high in RSI. So that is a good thing. That's not divergent. But then we made a new top here towards the end of July, and the RSI didn't make a new high. Excuse me. And now again. I think it was middle of August, we made a new all-time high. And look at the RSI. So RSI is the relative strength index, and it measures like moving averages. So he thinks this is really flashing warning signs. And I know, Clive, we've been talking about melt up, and we've had a melt up, I guess, since April. But it looks like, Clive, a melt up is dependent on the Fed keeping policy accommodative. And as we know, that's something that's not really happening right now. And there is a battle, of course, between the administration and the Fed for rate cuts. And the other thing, Clive, that I just looked at this morning was the Fed's balance sheet, and I put it for just 1 year because the 5 year, yeah, you can see that they've been doing quantitative tightening. I think this was when we had the SBV, the regional banking crisis. They had to pump up the system again. And if you go to a 1 year chart, you can see better what they're doing in the short term. And it looks to me like the Fed is really tightening here by allowing the balance sheet to run off. So maybe the Fed, maybe President Trump might be right about the Fed having to stop tightening and maybe not even cut rates, but stop doing QT, I would say. And maybe that's what could trigger a big correction in the stock market. But I'm not trying to guess why that would happen. But I'm just looking at the technicals. Doesn't look very good.
I'm not much good at charts, so I prefer to use my gut feeling. And my gut feeling is we're in for a little bit of a rout in stocks. But every long-term bull market is climbing a wall of worry, and you'll always have these routes. I don't think the bull market is going to go away. I mean, I think the wall of money is still there, but of course, it wouldn't surprise me if we have a 20% dip in stocks. That would not be surprising in the slightest. But if that happens, it'll worry a lot of people, and they're going to be looking for a home for their money. And where are they going to go in, Mario?
Well, a lot of people might think, well, we need to sell the miners and gold, and I think uh, they're going to be proven wrong this time around. And I'm going to show the viewers and people why this time around we could actually see gold, silver, and the miners do really well while the stock market drops. And Clive, yeah, you're right. If there is a 20% correction, and that's very possible. We had a 30 plus correction in 2020, and they stepped in and threw the whole kitchen sink at it. So I think they'll do the same thing. That's maybe why you said, in the long term, it's a bull market, it's a wall of worry. But yeah, I wanted to because I looked at that S&P divergence, and then I wanted to see how I'm trying to find it here. I wanted to see how the miners, especially the GDX, is looking versus the S&P. So I'm going to bring this chart up, and
So while you bring that up, yeah, I can tell you the mining ETFs are going up even on the days when the gold price is going down.
yeah, that's quite bullish, I think. Yeah.
Money is flowing into the mining sector now, and where is it coming from? I guess it's coming out of a little bit out of the tech stocks.
Yeah, so what I've done here, this is on TradingView, and I don't subscribe to them, so anyone can do this. I put the S&P 500 divided by GDXJ. So you can see here that since the beginning of the year, the GDX, not GDXJ, it's just the GDX, excuse me. GDX has outperformed. And you can see here that we had that big kind of mini crash after Liberation Day in beginning of April. And yes, and then it bottomed, the general stock market bottom and rallied, and it's been rallying. And you'd think, well, the stock market is outperforming the miners, but it isn't. And Clive, this looks to me like a consolidation, and it looks like we're breaking down again, i.e. the S&P is breaking down again versus the GDX, the big miners. We could look at the GDXJ, but I think it looks very similar.
It would be the same, Mario.
Yeah.
I would have done that chart upside down or the other way around because what you see is a falling chart.
Yeah.
But the falling chart in this case does in fact mean that the mining stocks are performing better than
Yeah.
the S&P 500. But what you're showing is the S&P 500
Yeah, I can
performing worse than the miners, which
I
is kind of
can
back to front.
I can swap it around, but yeah.
But yes, it's a it's clear evidence that despite the huge rally we've seen in the S&P 500 since that bad day, what was it, Independence Day or whatever they called it. So
Yeah,
despite that
April.
huge rally, the S&P, the mining stocks are outperforming the S&P.
Yeah, so that's why I think it would be, even I was thinking, Clive, this morning when I was walking Rudy, because I was thinking about the S&P divergence, and I think, wow, if there is a big correction in the general stock market, what's going to happen to the miners? Should I sell like a percentage just to have some cash? And then when I got back home, I thought, well, I'm going to look at the this ratio to see what it's telling me, and it's clarified to me that if anything, I'm going to hold on and maybe even add to the miners as we approach maybe a correction in the stock market. So I've got another chart. Well, that's that one we've seen already. Let's delete them. I've got another one. Oh yeah, I've got this here as well, Clive. I don't know if you've heard of Robert Prechter. He was quite a famous Elliott wave analyst, and he posted this a few days ago. This is the ratio of unencumbered cash to gross assets in hedge funds quarterly. So he says here, hedge funds are so invested that they are down to 5% cash on average, about one third of the level a decade ago, and the trend has accelerated since 2022. So that there is a little bit of a contrarian indicator for the stock market. It means that maybe hedge funds are too bullish, and they have, I mean, for the since 2012, they haven't been as bullish in stocks, i.e., they're holding very little cash. So I think that's a good indicator there. What's your opinion on that?
Well, I don't think they're going to reduce their catch much further because they've got to have 5% to pay their fees. That's hedge funds charge an arm and a leg. And they obviously need to keep some cash. But it's funny that I didn't even know that kind of statistic was available because I thought hedge funds were very secretive things and you can't look inside. But apparently, he's got the information from the Office of Financial Research, whatever that is.
Yeah, it's a government office. It says financialresearch.gov.
I
So
mean, all these hedge funds, they're registered in places like the Cayman Islands and offshore. So how are they getting the information? I don't know.
I don't know. Yeah, that's a good question actually, but we'll take Robert Prechter's word for it.
Yeah, we have to.
Yeah.
But yeah, if they're reducing the cash, it shows that the hedge funds are becoming well, they're becoming excessively bullish. But if you look at the results, the long-term results of hedge funds, you'd have done better just buying the S&P 500 and sitting on it rather than owning any hedge fund, more or less.
Yeah,
I mean, there are some which claim to have much better returns. Just to do justice to the injury, there
yeah,
will always be some outliers who are doing really, really well,
yeah.
or say they're doing really well. But a lot of hedge funds which did exist are now out of business. They shut down, return money to investors. Why do they do that? Because they're not making enough to pay the founders, and the founders say, "Well, I'd rather give the money back and manage my own money because I can't give the investors the return they expect."
Clive, I saw this post yesterday by Luke Groman, and it's weird because I never really bothered to compare these two, and I should have. But he says belated Nixon closing the gold window anniversary. So I guess he was about a week late, but it doesn't matter because it's a really good analysis here. So you've got the S&P priced in gold, that's the blue line, and the S&P priced in fiat dollars, the red line, since August 1971 when Nixon closed the gold window. And it's amazing that it shows really that gold is a true, in my opinion, revealer of wealth because in gold terms, the S&P is down 21. I'm going to increase it here, down 21.08% since 1971. It's not much. I mean, it's been pretty steady. I guess it's been, and if you add the dividends, that's probably done okay. The SPX versus gold. But yeah, in terms of the fiat dollar, though, it's up 6,330 three 339.88%. So I think what it tells us, Clive, is that under a fiat currency system, the people who have wealth, they're going to put it to work. They're not going to leave it in the fiat currency. And unfortunately, the people, the bottom 50%, they're struggling to make ends meet, so they can't save. And they're the ones that are hurt. And I think it's one of the reasons why wealth inequality has gone up so much.
Well, you know what this tells me? If I look at this over the 50 odd years, you've only lost 21% relative to gold in the S&P 500. That's less than a quarter percent a year, probably less than half a percent a year that you've lost. It's almost nothing. So for those who've got the S&P 500, it's not too late. If you've only lost half a percent a year, it's not too late to take a little bit off the table and put it into gold. I mean, okay, it might hurt a little bit to buy gold at a higher price than you could have had it 50 years ago, but the difference isn't that big.
Yeah, and Clive, with that, I wanted to make an announcement because I've talked a lot about this book, A Pocketbook of Gold, a survival manual for monetary mayhem, and I think we're right there. The monetary mayhem starting. It's by Jim Sinclair and Peter Carlin, and Jim Sinclair unfortunately passed away a year and a half or two ago. And this book, I bought it in 2010 from Jim Sinclair's blog, and I don't know how much it was, maybe $30 or whatever. But it's a very limited edition, and the viewers have complained that this book is like hundreds of dollars on eBay. But I've got good news. The good news is I was contacted by Peter Carlin. Because he said he's watched my videos and he's seen how I promote this book. And guess what? They're gonna start a new edition. So we're gonna get some new books coming out, and he's also gonna come on the channel in September. So that should be good. But and one of the reasons I brought this up, Clive, aside from letting the viewers know they're going to be able to buy the real thing, is that there's a part here about gold, and it says gold is a revealer of falsely stated wealth. So I think that's what that chart that Luke Groman showed shows. When people think, "Oh, we're getting rich buying the S&P," I don't think it's partly true, but it's partly not true either because you're just keeping up with real money.
Just on the S&P, we had some pretty awful results from Walmart last night. Whilst they said their same store sales were up, their operating income was down, and that disappointed Wall Street. The shares came off 4 or 5%. But then they went on to say that the second half of the year will be negatively impacted by the tariffs. So that really hit the retail sector quite a lot in the USA, and it shows us that probably for other American companies we're going to have lower profits coming, which plays into the story about could we have a sharp correction on Wall Street. But the first bit of that where they say same store income was up, but operating income was down. What's that trying to tell us? It tells us that the tariffs are already having an impact, but instead of passing those tariffs on to the customers, they've been absorbing them internally. Operating income goes up, goes down, so they've been. I think they've been absorbing some of the tariffs so far, but they're basically saying we've got no choice going forward. We're going to have to start passing these on, which means that customers will be impacted and buying less, and that's what they've basically said. But that's bad. That's bad for the whole of USA because it does indicate that people will have less spending, or there'll be less volume of goods going through the stores because they've got to pay more for the same goods.
Yeah, it's interesting because I always thought that would hurt the stock market, the tariff regime, because it's been mostly the big US corporations that have outsourced and their production and whatever so that they can get the cheap labor. So if you reverse that, it's like it's rational and it makes sense to think that their earnings are going to go down because they're going to have to maybe pay the tariff and take the costs, like you say, or maybe open a factory in the US, and that's going to cost and pay people more, so their profits are going to drop. So yeah, I think it's still early days, Clive, to see the impact of the tariffs. But I
It's
forgot. Yeah,
that's
go
right.
ahead. No, go ahead.
On that, it's very simple math. The average person, let's say a housewife, for example, she doesn't have more money in her pocket because of the tariffs. So let's say she's got $100 to spend, and up until now, $100 buys 100 different goods, as an example. Now, the price of all those goods are, let's say, 10% higher. So she can still only spend $100. She spends the same, but instead of buying 100 goods, she only buys 90 items. So that she doesn't get 100 items, she gets 90 items. Because she buys 90 items, it means everybody who's producing those 90 items has a lower volume and a lower profit.
I just want to go back a little bit here on the stock market and the miners. I forgot to show you and the viewers this one. This is the S&P versus the SILJ, which is the silver miners ETF. And that one looks pretty bearish as
Even
well, which is a bad thing for the S&P.
even more bullish for silver miners.
Yeah, we've broken like this low here from October last year. And actually, Clive, it's the S&P is lower versus the silver miners than it was when the stock market bottomed in April this year. So, like it was here, and now we're here. So,
The
yeah,
silver miners sector is a very tiny sector compared with the gold mining sector. And obviously, the gold mining sector is a very tiny sector compared with even one of the top 10 companies in America.
yeah.
So, if people do start buying the silver miners, that's the one which could really, really go to the moon.
Have you done a video on the silver miners? Because for those of you who don't know, and I'm going to share it, Clive. Clive has got his YouTube channel now too. So there you go. You can subscribe, Clive Thompson. But yeah, a week ago, you talked about 10 outstanding gold mining stocks. Uh, and I was wondering, have you got something on silver as well?
Well, first of all, I'm pleased to say that each of those 10 stocks is now up from when I did the video.
That's
Not
good.
not 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 because I did the video, but because the whole sector is up.
Yeah, yeah,
So it's nothing to do with my video. But yes, on the silver miners, I'm very advanced in, and I hope it'll be in the next 7 days. But it's a lot of work on
yeah,
producing a video on silver miners. I don't want to say names just yet because I'm working my way through each and every one. I've got to read the quarterly reports, absorb. I do a lot of number crunching. But what I can say are there are some very exciting silver miners, and the ones I'm looking at are the ones who are making money. They're pulling the silver out of the ground, and they're going to pull more silver out of the ground next year. Now, that's the last bit is the most difficult bit because a lot of them are going to produce less silver next year. Um, but you want to buy ideally the ones which are making a nice profit and will make a lot more profit because they'll have a higher silver price, which we already got now, but it's going up again, and on a higher volume. You want those two things together. What I'm not looking at are the silver prospecting companies, the ones who've got a hole in the ground and a liar sitting at the top, because there's a lot of stories out there about we maybe found a ton of silver, and I've been around the block long enough to know that most of these stories don't actually work out.
yeah,
Even if they do, even if they find the silver, the
yeah,
problem is getting the finance to dig it
yeah.
up, and that can take
But
many, many years.
yeah, I agree with that. But a lot of times, these junior exploration miners, silver, they are necessary because sometimes the big silver producers they don't have time to do the exploration. So yeah, like you said, many of them will result in nothing, but some of them will find some deposits that could be interesting, and they'll be gobbled up by the bigger companies that are already producing. The other thing, Clive, that I did back in well about 20 years ago, because I started out buying physical, gold coins and silver in '02, '03, and by 2004, 5, I started looking into the miners and I didn't know which one to buy. So I looked at a fund at the time called the Tocqueville Fund, a precious metals fund. It was one of the biggest. They didn't have, I don't think, GDX ETF or anything. And I looked at their prospectus. I also think I looked at the Sprott asset management and it's all public information and they give you which companies they own, which ones they own the most, so you go through the list and you pick as well, or you also watch Clive's videos, and do both, I would say.
Let me just say one of the things I'm really looking for. This is a really hard search, but if you find it, it's the perfect company. What you need to do is find a company which has got a lot of silver in the ground, already digging some of it up, making a profit, but they don't have the money to expand on their much larger reserves, i.e., they can only do a certain amount. And here's the important bit, their mine is located very close to another company which is doing the same type of thing, silver or gold mining, which would like to expand its reserves. So you're looking for something, a big company next to a small company. Small company's got the reserves, the big company's got the money. And in that kind of situation, it's almost a no-brainer that the big company has to buy the small one. Now, that's what I'm looking for. I can't guarantee I'm going to find exactly that, but I'm looking for something as close to that as well, because that's a really bullish signal if you can get that.
Yeah. Clive, maybe we could switch over to the Fed and also what's happening today at Jackson Hole. And I'll let you talk about it because, yeah, even though, yeah, I know what's going on, but I want to
But
have your take on it.
well, obviously, the big story today will be what happens at Jackson Hole when Chairman Powell speaks at 4 p.m. European time, 3 p.m. your time, Mario, and that will give us the signal as to what's going to happen to the interest rates. Interest rates. Now, the expectation for interest rate cuts a week ago, before the bad inflation news we had out of the United States, was 100% probability of a cut at one point. That since then, that probability of a cut has been falling sharply. I'm just bringing up the FedWatch tool now. There it is. It's on my screen already. It's just dropped. It was about 85% yesterday. It's just dropped to 73.3% probability of a cut. In other words, now 26.7% cut probability there will be no cut. So the probability of no cut is increasing. It's hard to say why, but the other thing is, which is going on, is international investors are starting to examine to what extent the Federal Reserve can remain independent. We mustn't forget what happened to Turkey when the government started to interfere in the central bank and firing governors who didn't reduce interest rates. I mean, we in Turkey we had the interest rate went not the interest rate, the inflation rate after that went to 40-odd%, and independent inflation monitors said that the inflation rate, the true inflation rate, was over 100%. Now, if the government takes control of what is supposed to be a sound money central bank, there's no stopping them from basically printing money beyond anything to pay for every bill under the planet. So where are we now? There are 7 governors on the FOMC, on the Federal Reserve. These are the 7 people who vote on interest rates. So at the last meeting, there were 5 governors who voted to keep interest rates where they were. So President Trump doesn't like them, and 2 who were dissenters, the first dissenters in decades. Normally, the whole board is in agreement. These 2 dissenters, Michelle Bowman and Christopher Waller, dissented and were now, in a way, sitting in Trump's camp, calling for a reduction in interest rates because labor numbers were pretty awful. So 2 out of 7 were in favor of a rate cut. 5 out of 7 said keep rates where they were. Since then, we've had one of the people who are in favor of staying where we are, called Adriana Kugler. She unexpectedly resigned 5 months before her term is up. A very unusual thing to do. And her excuse was something along the lines of, I'm going back to academia. You can believe her words or not, but I don't think anybody in their right mind would just resign 5 months before their term is up because they want to go back to academia. It doesn't sound quite right to me. So I think I don't want to say she's pushed, but there's obviously some sort of upset there. I don't know what it is. And now this week, just coming up today, apart from the pressure being put on Trump, put by Trump on Chairman Powell, we've had this news about one of the Federal Reserve governors called Miss Lisa, or I don't know if she's Miss or Mrs. Lisa Cook. And basically, President Trump is calling for her resignation over some allegation, which I think might have come out via a tweet. At least she says it was just a tweet by somebody, about whether she did or didn't claim a house was her principal private residence when applying for a mortgage.
Yeah, Clive, can I just interrupt slightly? You said that lady Kugler resigned, and she voted to keep rates unchanged. But now Trump nominated Stephen Mirren, who worked
Exactly.
at Council of Economic Advisors, and his big thing is to have a weaker dollar and a Mar-a-Lago summit to rearrange.
Yep.
Yeah. So he's going to vote for a cut. So if
So
they
that's
can get Cook,
three out of 7.
so if they can get Cook out, they're going to get 4 out of 3.
4 out of 7.
But
Exactly.
4 out of 7, sorry. But you also have there are other voters though. There are another 5 voters from the regional banks, right? They alternate. Not all 12 heads of the regional banks vote. So I don't know how those are voted last time, But I think if the board was in favor of a cut, it would be very difficult for the regional banks to not
Yeah.
go along with
I
it.
mean, if obviously Lisa Cook has said she is not going to be bullied by
Yeah.
these threats, so she says she's not going to resign. But let's wait and see. Let's suppose that she now feels that she's under pressure to support an interest rate cut because that will take the pressure from President Trump off, or take the focus away from her, perhaps. I don't know. I don't think she's saying the right words that she's not going to be bullied into anything, and that's the right thing to say. But obviously the pressure is on the entire board to fall into the Trump camp, and basically what Mr. Trump would like would be the Federal Reserve to cut rates and cut it multiple times and by a lot.
Yeah, yeah, and yeah, they're probably looking into all the other governors, their activities in the last 25 years, what they've been doing, trying to find dirt on them. But Clive, the other what did I want to show you? Oh yeah, the bond market, because you noted that the inflation numbers in the US weren't good, but also in the UK a couple of days ago, we had CPI was a lot higher, well, was higher than expected, and the RPI as well is approaching 5%. And in the past, if that were happening, the Bank of England wouldn't be cutting rates like they did recently. They'd be either keeping them unchanged or raising them. And the UK bond market, I'm going to bring it up here this morning, what it's doing. We're very near, I mean, we're way past the levels that we were, Clive, when we had the crisis in September of 2022 with Liz Truss and Kwarteng. So it's funny because on Wednesday, when the CPI data came out, I thought the bond market would drop, but it actually rallied. But yesterday, yields came back up and they're continuing to go back up. So you can see the 10 years at 475 basically. And I think if we break 480, that's pretty bearish.
Well, just to tell you, Mary, I'm looking at a completely different website. This one's Market Screener, and it's showing me that UK 10-year cash yield is 4.83 now.
Wow,
So
yeah. So you
I don't know
never
which
know.
what one of these two is. They're both supposed to be up to date, but one of these two is showing a slightly different rate.
Let's have a look at Bloomberg because I subscribe to Bloomberg. Not
And I
not
could
the
look at
terminal, but I subscribe to the website, rates and bonds.
pulling up
So
trading view to
okay,
see as well.
okay, 10-year gilt yield. Well, the Bloomberg says 474.
Okay.
So and
The one
559.
it's possible the one I was looking at might have been a little bit out of date.
Yeah.
It was coming from Market Screener.
Yeah, but even in
Bond
the
yield.
US, Clive, uh, yields are also creeping up. We're back at like 433 in the 10 year, and we're approaching 5% in the 30 year, and it's still very stable. But if we start seeing these yields spike, this could be also the trigger for a correction in the stock market. I think the 30 year, the key level is just above 5%, around 506, 510. And yeah, keep an eye on these. And it's weird, Clive, because not weird, but it shows that investors are not convinced about inflation. I don't know if you saw earlier this week, there was a consumer confidence or one of the surveys, maybe it was last week, the Michigan sentiment and the inflation expectations for 5 years forward was like almost 5%. So anyway,
I mean,
yeah,
inflation is going to come back. We're seeing first of all the PPI last week announced where the monthly increase was zero point 0.9.
yeah,
Now multiply that by 12, and you've got a rate of inflation of over
mm,
10% in producer prices. Okay, that was just 1 month, but I imagine that it's going to be just as big an increase next month because there's more and more tariffs coming in. So
yeah,
if we've got an inflation rate of at the producer level of over 10%, at least some of that will get passed on to the retail sector. So I
Yeah.
wouldn't surprise me one little bit if we see inflation heading to more towards 4% in the UK. Sorry, not in the UK, in the USA at the consumer price index level, rather than heading down to 2.
Yeah, and the one thing, what I wanted to say, and I kind of forgot, is that when the Fed cut rates last year, they did it three times. In September, they cut by 50, and then they cut another two times, 25 each, so 1% or 100 basis points. Ever since then, and I think they started September 18th or something like that, the 10-year yield was at 3.6. And now, despite the Fed funds rate, which controlled the short-term rates, being down 1%, well, that is up about 75 basis points. So uh, I think the Trump administration and even Besant, who should know better, they should realize if they cut really aggressively the short-term Fed funds rate, you could see actually that backfire and move the yields in the longer end even higher, which would be really bad for the Treasury.
I think they've got to go higher. I mean, it should be obvious to anybody that if you buy a bond which matures in 10 years or more, what you'll be able to buy with that bond when it matures, assuming it matures at all, will not be as much as you can buy with it today. So whether we're talking about housing or old care in your old age, or going on a cruise, or gold or stocks, it doesn't really matter, or a fine painting, all of these things in terms of what it will buy, it won't buy as much in 10 years' time as it buys today. And of course, there's a lot of things which might go terribly, terribly wrong in the next 10 years, which might mean you actually end up with virtually nothing for your 10-year bond. It might be a defunct currency.
Yeah, and Clive, you were talking earlier about like central bank independence and how Trump is pushing the Fed to cut, but it looks like this came out a few days ago, and I've spoken about it before in one of my videos. It says investors warn of new era of fiscal dominance in global markets. So they're warning here that it's not just in the US that the politicians are going to push the central banks, but it's also in Europe. And I think that's very bullish gold. And how can they do this? Well, they can push the central banks to restart QE or do yield curve control so that they can keep running 3-4% inflation while bond yields are like maybe 3 or 3.5. So investors are going to get, yeah, they're going to get fleeced. That's what it looks like. And even the FT is warning that.
Mario, I've been investing money for 50 odd years, and I keep getting punched on the nose because I don't learn lessons, or at least I eventually learn them. And I think one of the lessons I learned and it was around the 2008 global financial crisis point, I had been reading in reputable financial journals like the Financial Times, the Wall Street Journal, and The Economist that the US housing market made no sense. And they were talking about these mortgages being granted to people who could never afford to repay, and how they were being bundled up and stuffed into these things. So I'd read these articles and shrugged my shoulders and said, yeah, yeah, move on. It's all rated AAA. Why would I care? Despite the Economist saying this is a bunch of crocker shit. I should have listened to the warning signs, and I didn't. And I ended up owning things which, if I had paid more attention to those warning signs, I would not have owned. Now, having learned that lesson, when I start to read in papers like the Financial Times, like the article you just read, that there are problems with the government debt, there are problems with the way things are going, I now pay attention. And we're reading the warning signs coming out of all the reputable journals, basically saying the level of debt is completely unsustainable. It cannot continue. Something is going to go wrong. Well, there's no guarantee it's going to go wrong, but pay attention to the warning sign and do something
Yeah.
about it. And do not own, in my case, I say do not own any long dated bonds. You're going to come a cropper.
Yeah, even though they're about 5 years, 4 years late, the FC is better late than ever because we've been warning here, Clive, for quite a few years about that. And you talking about mortgages given to people who couldn't pay. I remember, I think in The Big Short, there's a scene where these guys go down to Miami to research these subprime mortgages, and they knock at one of the houses. And the guy says, "I'm looking for so and so," and he said, "Oh, that's my dog." So, uh, I never took a mortgage on Rudy, but that's what happened. It's such a, yeah, Rudy and Echo has a 30-year mortgage anyway. But Clive, any final words before we wrap up?
Well, thanks very much, everybody. First of all, if you want to know which gold mining stocks to buy, or at least this is not investment advice, which ones I've chosen to buy for myself, look at my video on YouTube under Clive Thompson. I will be bringing out a video shortly about something which amazing, which happened between unrelated to gold, but stock picks that I made and what AI said about them. It'll astonish you all. I'm not going to tell you that. I'll just leave that as a taster. It's not out yet. It'll come out in the next 7 days. And I will be bringing out a video on silver mining stocks. And watch that. And if you'd like to know if your silver is real, have a look at my channel, Clive Thompson, and there's a video on how to test your silver in 7 different ways.
Yeah, all right. And talking about silver, here's my silver dollar.
Beautiful.
Yeah.
I love those.
Yeah. Anyway, Clive, have a great weekend. Great weekend to you as well. And thank you for all your support. And again, if you like watching our channel, Clive and my channel, but haven't subscribed yet, make sure you do. So take care, everyone. Bye.